Welcome back to the deep dive. We've got quite a stack of sources you sent over, all pointing to, well, one of the biggest market stories unfolding right now.
It really is something.
Yeah, so our mission today is basically to unpack this. The historic, frankly unprecedented surge in gold prices as of, well, right now, October 2025.
And this isn't just noise. It's not just another market tick. This is a headline that has, every major central bank, every
Okay.
sovereign wealth fund paying very close attention.
Right.
When the world's oldest sort of financial asset starts moving like this, it's basically screaming that something fundamental is shifting under the surface.
Absolutely. And the shock value, really, it's all in one number. Spot gold isn't just high, it's blown past a major milestone. For the first time ever, over $4,000 an ounce.
That's right.
The specific peak we're digging into hit $4,036.79.
Just pause and think about that number for a second. And the context here from the sources is crucial. Gold has essentially doubled. Doubled in value in just the last 2 years. That tells you capital's fleeing traditional assets. It's running for cover, finding refuge in gold at a speed we haven't really seen since, the early 70s.
Wow.
That acceleration is just an extraordinary signal of global financial stress, serious risk aversion.
So that's the key thing for you to grab right away, that doubling in 24 months. Okay, let's set the stage properly. Let's lock in these numbers and the immediate context. We're talking $4,036.79 per ounce peak price as of October 8th, 2025.
And just to underline, this isn't purely a U.S. dollar story, right? This is global.
Okay.
If you look internationally, like in Australian dollars, for instance, the price is around $86,031, $37,000 per troy ounce.
So it's hitting records everywhere?
Pretty much. The consistency across all the major fiat currencies, it just confirms investors everywhere are looking for the same exit ramp, getting away from currency risk.
Okay, so the number's huge. We get that. But the question is, how did we get here right now? The sources seem to point to a kind of triple whammy, almost a perfect storm of risk factors.
That's a good way to put it, yeah.
We've had this persistent kind of structural inflation problem for a while now, right?
We have. It's been eroding value slowly.
But then you layer on these two, acute disruptors, a prolonged U.S. government shutdown, and these sharply escalating geopolitical tensions around the globe.
And that combination is just devastating for market confidence. Inflation, as you said, it's like the slow poison, right? It chips away at the value of money over time, pushes cautious investors to look elsewhere. But the political stuff, the shutdown, the rising global tensions, those are like alarm bells. They tell sophisticated money, hey, the system itself might be unreliable.
Let's pause on that shutdown piece for a second, because a prolonged one, that's not just internal U.S. politics, is it? What's the specific signal that sends globally about, financial reliability?
It signals a governance crisis.
Yeah.
Right at the top of the world's biggest economy. Historically, any shutdown sparks worries about the debt ceiling, the U.S. ability to manage its finances.
Sure.
But a prolonged one, to outsiders like, foreign central banks, it looks like administrative chaos. And that just craters confidence in the stability of U.S. treasuries and, by extension, the dollar itself.
Okay.
So gold, in that picture, it becomes the ultimate political insurance.
That distinction is key then. It's not just the economic decay from inflation, but this acute political risk, the shutdown, the tensions. That's maybe what makes this different from past gold rallies. It's fear of the balance sheet and the political structure.
Precisely. Both are under question.
Okay, so before I move on, just thinking about those three factors, the ongoing inflation, the U.S. political mess, the global friction, what do you think hits the market hardest? Is it the slow burn or the sudden shock? Something for you listening to ponder, too.
That's a good question. They feed each other.
Okay, let's pivot now. We've talked about the what the price and the why now, the perfect storm. Let's get into the who. Because this huge move, it's not just small retail buyers, right? This is institutional power-moving market.
Absolutely. That's the core of it.
So let's look at these driving forces. Why are the big investors, the central banks, making this shift?
Well, the foundation, like we touched on, it's that basic human and economic need for safe haven. It's psychology meets economics.
Right.
When your cash is losing value, your bonds aren't really returning anything after inflation, and you see governments struggling to even fund themselves. Money has to go somewhere physical, somewhere globally accepted.
And that's gold, the classic counterhedge against, economic trouble and currency losing value.
Exactly. But, and this is where, like you said, the story gets really interesting, where you see the systemic shift. It's the institutional behavior. That's what provides the sheer scale, the liquidity for a move like this. We're talking central banks.
Buying gold at record rates. That's what the sources flag.
Record rates, yes. That's the structural change pushing us past $4,000. The sources point to aggressive buying. They mention China specifically. But look, they are definitely not the only ones.
No.
And this buying spree, it's not just, diversification for the sake of it. It's a very clear strategy. It's designed explicitly to reduce their reliance on the U.S. dollar as their main reserve asset.
Okay, can we unpack that diversification strategy a bit? Is it mostly worry about U.S. debt levels? Or is it also tied to how the dollar's been used, for sanctions and things like that recently?
I think it's a mix, but that sanction risk, that's a huge psychological driver, especially for nations not closely aligned with the U.S.
Right.
Think about it. If a huge chunk of global trade happens in a currency that one country can just decide to freeze or restrict based on its politics, well, every other country has a pretty strong reason to find an alternative, don't they?
Yeah, an existential reason almost.
Exactly. Gold is decentralized, it's physical. It bypasses that risk completely. So the buying, it represents this deliberate, long-term move towards de-dollarization. And that gives gold a demand floor that just wasn't there, say, 5 years ago. It's structural, not temporary.
And just to add another layer of validation here, showing this isn't some fringe movement, you look at who else is talking about gold. Investor sentiment is getting boosted by some really big names.
Influential figures.
Yeah, the sources specifically mention prominent investors, people like Ray Dalio, explicitly backing gold, calling it vital for portfolios in this kind of turmoil.
And Dalio's voice carries weight.
Ooh.
Right. Because he manages enormous amounts of very sophisticated money.
Exactly.
So when someone like him publicly says, look, gold is essential now to preserve wealth amid this, global financial stress, it basically gives permission, gives cover for other big institutional funds, pensions, endowments, other hedge funds to jump in too.
Right.
It shifts gold from being maybe a bit on the edge to being a core mainstream risk management tool.
Right. So let's pull this segment together. The price surge is this powerful mix. You've got the macro instability, inflation, geopolitics, governance problems, meeting this huge institutional action, primarily central banks backing away from the dollar, and then validation from top-tier investors like Dalio. That's quite a combination.
It's an incredibly powerful trifecta. And it explains why the move has been so strong and so persistent. It's not like a quick flash crash or a short-lived geopolitical spike. These drivers are deep, structural. They won't just vanish overnight.
Which sets us up perfectly for the final piece here. If that's the reality now, what's the outlook? Where do things go from here? We need to look ahead, see what the analysts are forecasting for gold's path.
Well, given everything we've just discussed, this deep lack of confidence in the traditional financial systems, the analysts are pretty much in agreement. They overwhelmingly expect this upward momentum to continue.
They don't see a quick fix.
No. They don't see the things driving central banks to buy or investors to flee getting resolved anytime soon. So the demand for physical gold, it's expected to stick around, maybe even pick up steam.
And we actually have a concrete forecast mentioned in the sources, a big one, which really underscores how serious this outlook is. Goldman Sachs specifically has just dramatically upped its gold price forecast for 2026.
Yeah, they're not just talking about a small increase, are they?
Not at all. They are now forecasting gold could reach, well, an absolutely staggering $4,900 per ounce by 2026.
$4,900.
$4,900. That's almost another $1,000, nearly, from the peak we just hit around $4,000.
What does a forecast like that tell us about their view of global economic stability over the next, say, 18 months?
It implies extreme uncertainty. Plain and simple. The Goldman analysts, they explicitly cite ongoing economic uncertainties as the driver.
So they're basically pricing in continued, maybe even worsening, inflation, plus persistent geopolitical friction, plus more instability in government debt markets. A $4,900 gold price, it suggests a flight to safety that's bordering on, well, institutional panic.
Wow.
It means they fundamentally believe this structural shift away from traditional fiat money assets is just going to keep going, full steam ahead.
So the implication for you listening is pretty clear. This isn't just a story about a shiny metal. It's acting as a really reliable signal that the world's most sophisticated money managers are seriously hedging against systemic problems. This move really hammers home the idea that confidence in the current financial order, it's fundamentally shaken, maybe broken.
And this isn't just about short-term trading. This demand, it's driven by a core belief that this environment we're in, high inflation, political deadlock, geopolitical tension, that this is the new normal.
Hmm.
And that requires a total rethink of how countries and institutions manage their assets.
Okay, that brings us towards the end of our deep dive for today. Let's just quickly recap the absolute key takeaways for you.
Right. First, that dramatic milestone. Gold hitting over $4,000, specifically $4,036.79. It's a major signal of acute global financial stress.
Got it. Second.
Second, the engine behind this, it's institutional strategy,
Hmm.
particularly central banks buying gold like never before, trying to get diversification away from the US dollar and hedge against rising political risks.
And third, the outlook is incredibly bullish. You have major players like Goldman Sachs now forecasting gold could hit $4,900 by 2026, and they're pinning that directly on ongoing economic uncertainties.
Yeah. So the so what for you listening is actually simple, but it's profound. Understanding gold's moves right now is vital because it's acting like the clearest, most unbiased barometer we have for global economic anxiety.
Hmm.
And maybe more importantly, for the perceived stability of all government-issued currencies. When gold surges like this, it signals deep, deep distrust in the value of government promises.
That's a really powerful place to leave it. So, building on that, here's a final thought for you to mull over based on everything we've discussed. Given that the main drivers seem to be this sticky, policy-driven inflation and rising geopolitical tensions, what kind of huge, concrete policy changes, we're talking bigger than just tweaking interest rates, what would need to happen globally to actually reverse this flight to safety, to restore that deep, long-term confidence in traditional financial assets again? Something to think about.